Vaxart, trading under the ticker symbol Vxrt, has been the topic of many conversations, and in today's video, we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is still very volatile for the time being, we should always be careful about which positions in stock we pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to give it a like, short comment, and subscribe to my channel. Vaxart has been having a decent run over the past 30 days or so, as the stock did manage to maintain its support during that period of time. With that being said, I think that ultimately what matters to shareholders is that Vaxart has been promising a revolutionary product or a revolutionary way of delivery to the market, which has been met with relatively large quantities of skepticism at the time, along with some disappointment with medical tests not meeting the regulators' standards. Overall, the stock performance of Vaxart has been relatively disappointing, to be honest, even though in the grand scheme of things, it may have fallen relatively less compared to many other tech stocks. Nevertheless, I think that the future still has quite a few challenges for the company. First of all, the overall demand of the market may have already been taken by more established players, including the relatively young and green Moderna, which impressed many by competing almost as equals to major players such as Pfizer. Now, let's also take a look at the technicals of Vaxart. The trading volume of Vaxart has recently been around 3.1 million shares versus an average volume of 2.9 million shares. Over the previous 52-week period, its price fluctuated between $2.50 and $10.33. The trading volume is a metric that can tell you how many shares are being exchanging hands and whether there's a lot of activities and attention on the stock. It often gives you a first idea about the popularity of the company, and when we use it to compare to the average volume, it can also tell us if the company is enjoying additional momentum to reverse its trend or to break through the current resistance levels. Even when the current volume is lower than the average, it is an interesting indication, because it may signify that a trend reversal could happen soon. The market cap of Vaxart is currently around $529 million versus the enterprise value of $511 million. To put simply, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for its assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies could be the intangibles, meaning they're not items or concrete things that a company can use to generate income now, but they're often the living proof that a company can grow significantly in future, such as the intellectual properties, schematics, or branding. For many startups, most of their valuations are usually based in the intangibles, meaning they can be valued in more favorable market conditions, resulting in a huge difference between the market cap and the enterprise value, which gives a false impression to market participants that a company is trading at a discount. It's only trading below the book value, but doesn't mean that a company itself is necessarily undervalued. It's also possible that a company itself was overvalued in the first place and that it has deflated itself ever since. As we compare the current price to the historical price fluctuations, the stock is 60% higher than the 1-month low, 68% higher than the 3-month low, and 68% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment on where the stock price is likely going to go next, the implied volatility is 108% versus a historical volatility of 103%. The put-call volume ratio is currently at 0.29. It is normal for many stocks to also tend to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 3.5 thousand contracts versus the 30-day average of 2.3 thousand. In terms of open interest, the most recent volume of open interest has been 50,000 contracts versus the 30-day average of 49,000. The option contract is a derivative from the underlying security, giving participants the possibility to have a right to either buy or sell the security at a predetermined strike price. Buying the contract would give you the right, and selling the contract would give you premiums, with the obligation to execute the contract if the counterparty chooses to do so. It is often said that you can evaluate the likelihood of a scenario based on the opposite of what the current ratio is. If there's a lot of put options, then there could be possible uptrends on the move, or that the reversal could happen if there's a lot of call options. The reasoning behind the theory is quite simple. Most options expire worthless. In terms of its shareholder structure, institutional shareholders own about 38% of the total float. The biggest shareholders include Vanguard, BlackRock, and SPDR Biotech. It's relevant to understand the shareholder composition of a company because this could help to determine whether you should hold the stock long-term or to view it as a trade opportunity. If the stock is held by retail traders, this could be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be about 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Obviously, there's a lot of exceptions to this since many great companies are also mostly held by retail, not institutional investors, but that tends to be the exceptions and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. At times, there could be significant short interest in the total volume, which can be a sign of an organized shorting operation happening, such as what happened with GameStop and AMC. The current short interest is 19% of the total float, with 32% of it coming out of the dark pools. Usually, if 15% or more of the short interest exists in the total volume and a significant portion of the short volume is coming out of the dark pools, this can be a sign that institutional positions have taken a short position against the stock. My recommendation on Vaxart is to exercise additional caution when buying its shares and try not to hold for long term. The company's history doesn't justify such a decision, and so far the company has yet to prove to the market that it has an important proposal of value at this point in time. I would recommend to commit between at max 0.5 to 1% of your portfolio in Vaxart and to split this allocation in 10 or 20% at a time so that you can purchase more in further retracements. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.